In this video, I'm going to be telling you 3 investment locations, 3 hotspots, you could say, that you can invest in right now and that will give you some pretty amazing growth. I'll also talk about why the data factors that no buyer's agent is going to tell you that you can find these investment locations through yourself. And I'm going to talk about one of the common myths that you don't need to make a decision or a trade-off between positive cash flow and growth, how to get the combination. All right, so my name's PK and I help people build passive income by buying properties that have a combination of high growth and positive cash flow without using a $15,000 buyer's agent, without flying around the country, using data. And subscribe, like, hit the notification bell, tag someone, share this if it brings you value. Guys, let's get into it. So look, when Michael Jordan, a bit off topic, when Michael Jordan, started playing in the NBA, there were basically 2 types of players. There was offensive players, they're the ones who, dunk the ball and everything like that. And then there were defensive players. Michael Jordan was both. When Mike Tyson, started playing or started boxing, there was 2 types of fighters. There was lightweight and then there were heavyweight. Mike Tyson was both. He destroyed the competition. When Bill Gates, created Microsoft, at that time, there were basically 2 types of tech companies. There was one type that were focusing more on hardware, physical tech. And then there were another type that were focusing on software, all right? Bill Gates, Microsoft mastered both. And when Jeff Bezos started Amazon, basically there were 2 types of e-commerce strategies or e-commerce companies. There was pure online, like eBay, and then there was pure offline, like Kmart or Walmart in the US example. Bezos mastered both. And so conventional wisdom tells us that you have to pick a side. Like in property, you have to pick either growth or positive cash flow. You have to become binary. You have to become dichotomous. But this is completely, couldn't be further from the truth. All right, this is, the fact that one thing is right and the other thing is wrong. There's this debate of, growth is everything. Without growth, what's the point? And then the other side of the equation, all I want is passive income. I want positive cash flow. But if you want $100,000 passive income, then how many positive cash flow properties are you going to need without them growing? It's not possible. But then it's not possible to buy 5 high growth properties that are all negatively geared by $10,000 per year. Here's the thing. Mike Tyson, Jeff Bezos, Bill Gates, Michael Jordan, they mastered both. And if you want to develop a passive income, if you want to build a property portfolio, it doesn't need to be to the moon and 20 properties, but 3, 4, 5, 6, 7 properties, and actually be able to retire safely, comfortably, early, to spend more time with kids or just do what you want to do, then you really need to become like these people and master both things, positive cash flow and high growth. And I'm going to give you 3 locations right now that will prove to you that both sides of the equation do exist, that you don't need to make trade-offs. All right, and I'm going to give you these 3 locations. You can effectively turn this video off, go and invest right now in these locations, but I don't recommend you do so, and I'll tell you in a second. So I know most of you don't just want to be fed the answers, you actually want to learn. And all these buyer's agents, you're watching here on YouTube, if you're watching on YouTube, I know who you guys watch. There's probably like 3 or 4 other channels in Australia related to property that are worth half listening to. All they're doing is sharing you a bunch of principles, stuff that you can read in books. And then they're saying, guys, this is really hard. You need to engage me as a buyer's agent. You need to, fork out $10,000 to $15,000. You need to leave it to the professionals. Let me break it down for you. Let me really pop their bubble. Let me burst their bubble and just give you for free some of the things or a lot of the factors that you need to be looking at. I know so many of you just look at past growth, you just look at past yields, you just look at things like whether crime is low, you look at things that aren't really that consequential in terms of predicting growth. You're looking at the wrong factors. I've got them here on my phone. So get a pad and pen and write these down right now. What you really need to be looking at is 30 to 35 factors, that allow us to understand the balance of supply and demand. There's no one magic formula that will give this for us. We need to do it ourselves. So you need to look at factors such as stock on market percentages. You need to look at days on market trends. You need to look at online search interest ratios. You need to be looking at building approval percentages. You need to be looking at average vendor discounting percentages. You need to be looking at developable land supply schemes. You need to be looking at job advertisement trends. You need to be looking at mortgage affordability. You need to be looking at 30 to 35 factors. I can guarantee you probably never heard of half of these. Neither have buyer's agents. This is what it requires, or this is what it takes to take all 15,000 suburbs, ignore states, ignore cities, go straight to the suburb level and pick which fit your budget and which are positive cash flow and which will grow. Okay, this is the kind of data analysis it takes. And I can tell you, the other guy who looks a bit like me on YouTube, he's buying in places like Tamworth, where days on market is, let's say, close to 100 days. It's taking more than 2 months, 3 months to actually sell a house in places like Tamworth. So you got to ask yourself, house prices only increase when demand outstrips supply. If it's taking someone 2 months, if it's taking them 3 months plus on average in a suburb to sell a property, is demand very high? You don't even need to be a statistician to figure that one out. All right, guys, so let me cut to the chase. Let me give you 3 suburbs that my clients were investing in between 1 and 3 years ago. All right. And now we've stopped investing there. You can invest in there now if you want. All of my clients will thank me because there'll be a surge of enhanced demand. But you can reverse engineer and see why it is that we invested in these locations. So location number 1. The first one that I'm going to say is Orange. New South Wales, postcode 2800. All right, and so when I look at somewhere like Orange, when we started investing there, I think it was about a year ago, prices were about $400,000. All right, so $400,000, you're in Sydney, Melbourne, you don't need $1 million to invest in property. Prices right now, a year later, about $500,000. This is smack bang in the middle of Orange. And all these factors that I mentioned to you just a few minutes ago, they were all lining up like stars in the sky. And when this happens, then you know that prices will increase. Of course, then once we've selected the suburb, we need to select the right street, the right pocket, the right type of dwelling for both owner-occupiers and renters. But the suburb does the heavy lifting. All right, and get this, that yield a year ago, when we were investing in Orange, was 5%. So 5%, New South Wales has manageable stamp duty, but notwithstanding that, 5% is positive cash flow. Now the yield is more looking like 4 or just above 4. So it's still neutral. You can still go ahead and buy there if you wanted to. We're not investing there anymore. We've taken the profits, we've taken that equity. You can invest there right now. It will still go up. I'm accountable for these videos. You can assess in a year's time whether I was right or wrong. We've already made $100,000 in a year. You needed about an $80,000 deposit to get into Orange, including all transaction costs a year ago. You would have made $100,000. That's more than 100% cash on cash. And you would have been making about $3,000 or $4,000 or $5,000 positive cash flow every single year. So that's one location. The second location that I know you guys are holding out for, that you can invest in right now, is California Gully. California Gully. So where's California Gully? It is in Bendigo. So when we were investing in California Gully about 2 years ago, that's when we first started investing in California Gully. It's quite central Bendigo. You could buy a house for about $250,000, $280,000. $250,000, $280,000. You didn't need more than $50,000 to get in, right? And get this, the rental yield back then was 6%. That's huge. That's huge positive cash flow. Great money to be had. Now the median value has gone from about 250, or you could say 260, 270 to about 380, 390 on the ground right now, July 2021. In 1 or 2 years' time, that is how much prices have grown. So once again, you need about $50,000 to get in. In about 18 months, you've made $100,000 growth. That's 200% return on investment just by growth. Take that equity out, you can buy another 2 properties, and it was positive cash flow the whole time. All right, once again, the data lined up. And you're probably thinking, well, all right, well, these are all regional areas. I can't stomach that kind of risk, even though these are not risky areas at all. And P.S., these areas were growing before COVID started. So it's not just because of working from home and all that jazz. I know that's what you think. It's not. We were seeing the data line up even before COVID. It's more fundamental, structural reasons why these suburbs have grown. All right, so the third one, because you're kind of saying this is all regional, let's go to a capital city. Let's go to somewhere like Adelaide. So in Adelaide, there's a suburb, Flagstaff Hill, postcode 5159, that we were investing in around a year ago, or just over a year ago. Back then, prices were about 480, 490,000. Right now in Flagstaff Hill, I'm looking here at my screen, they're about 620, 630. So just over a year, you've made, once again, more than $100,000. To buy a $500,000 property in Flagstaff Hill a year or 18 months ago, you needed about 100K. All right, so capital cities, slightly higher entry costs. You've made 100K equity, so 100% return on investment. Back then, about 18 months ago or a year ago, the yield of Flagstaff Hill was high 4s, so more than neutrally geared, positively geared. Now it's more like 4%. But remember, even though right now the yield is dropping off, that's not affecting our yield or for my clients, because the yield is calculated off their purchase price. So their yield, because rents have gone up since then as well, is more like 6%. The yield has come down because the purchase price has gone up, not because rents have come down. Yield is a combination of rents and purchase price. So because purchase price or median value has gone up, that's why yield has come down. But because rents have actually gone up in that time, actual purchase price yield for my clients, they're sitting on more than 6% right now from those purchases a year ago. And so if you look at the data, you don't need to listen to me. You don't need to listen to buyer's agents. You just need to understand the data, and then you become self-sufficient, right? It's not hard to buy interstate. I've done so many videos on how to do that, client interviews on how we buy interstate without catching flights. You can figure that out by watching my client interviews and things like that. And here's the thing, just like Bill Gates, just like Mike Tyson, just like Michael Jordan and Jeff Bezos, we never make that distinction of positive cash flow versus high growth. You need both. If you want to build a portfolio, you need both of those things. And the highest performing property investors always get those two things. All right, that's how my portfolio is built. That's probably how most successful portfolios are built. Yes, it is, I wouldn't say harder, it is more rare, but that doesn't make it harder. If you have a scientific way to get there, you can get these types of properties. And here's the thing, often I post these client interviews and reviews in my Facebook group and here on YouTube, and we talk about how we got these properties off market. And so many of you DM me and they put in the comments, how are off market properties possible? Why would someone not list it if they could? There are umpteenth level of reasons or number of reasons why people would go off market. Some of them are, if they're, let's say, getting divorced and they just really need to just get this thing off their head, don't want to think about it. Another reason is they've already bought another property and they have a deadline to meet, so they can't be bothered or have the time to go through the sales process of listing it on real estate, etc. Another reason is because it costs money, $3,000, $4,000, $5,000 to actually list your property on domain or real estate. Another reason is because some people just don't want the foot traffic, people coming in, poking around their wardrobes and open for inspections, all these things. There are so many reasons why people don't want to list their property, why they would prefer to sell it off market. And I know all the buyer's agents say, oh, look, we have all the contacts, all the relationships, but honestly, guys, just watch my client interviews. More than 50% of our deals are done off market. None of my clients are professionals. They build these relationships with agents like in a matter of weeks, like 5, 10, 20 minutes every Monday. It's not that difficult. You can do this yourself. So go one better than Jeff Bezos, go one better than Michael Jordan, go one better than Mike Tyson. Then Bill Gates. Don't just get positive cash flow, don't just get high growth, get it off market as well. It's so much easier, and by getting it off market you can get it under market value. Who doesn't like a discount? I'm not saying that this method will get you $100,000 off the price, although I think our record is about $67,000. But even a $20,000, $30,000 discount, you'd take it every day of the week. So that's the diamond, right? That's the diamond strategy. Positive cash flow, high growth, under market value, off market. And if you can wrap that up, buy something that you can add value to in the future. My next video is probably going to be whether you should buy new or old. But one reason we buy established properties, not new properties, so we can add value, subdivision, granny flat, renovation, etc. I'll leave that for another video, but hopefully that's brought you some value, guys. So I talked about the data that you need to be getting, and this is not from CoreLogic, by the way. I talked about why you should never make those dichotomies, those binary decisions. You should always strive for positive cash flow and growth. And I gave you 3 locations that you can actually go away. And I guarantee you, there's a disclaimer below about how this is not professional advice or personal advice, but I can tell you that these suburbs are not going backwards because the data is still incredibly strong. All right, guys. Well, my name's PK. If this video actually brought you some value, hit the subscribe button, turn the notification bell on, hit like, tag someone who will actually benefit. Who doesn't want to know free hotspots? And guys, I'll leave a link below. I really want you to do this yourself. Like, I'm a big believer in DIY property investing. Try to do this yourself by watching my content. I have more than 100 videos now on YouTube. But if you can't do it yourself, there's a link below to my website. Check it out. If you vibe with me, then book a call. It's not cheap, right? So only do it if you've got some dough to spend, and I can help you. And in fact, I'll just teach you to do it yourself, so you're self-reliant forevermore. My name's PK, and I wish you all the very best. Catch you later.